The overarching theme of what markets seem to be trying to price in is, peak credit and profit cycle, slowdown next year, just risk off sentiment, and just an unwind of all these crowded trades. Brian, you going to sit there and say the market's got it wrong, or?
Well, no. I think what the market has right is that with policy uncertainty comes market volatility, and we're dealing with a lot of policy uncertainty right now. So one of the risks of late cycle stimulus was that you led to a stronger dollar, it raised interest rates, U.S. economy is now slowing. On top of that, we have concerns about the trade war. So the one thing that the supply-siders were taking away from the tax cuts was this was going to lead to new investment. And if you add tariffs on top of that, that slows business confidence, slows the economy. What I want to say is I think that there's a slowdown in U.S. growth, if we come to some agreement on trade, creates, dare we say, a Goldilocks environment for rates and inflation. That should be a good thing, but we need to get through this uncertainty.
So you're saying we got enough of a head of steam coming out of tax cuts to carry us through a period of not knowing what's next?
Well, we got enough of a head of steam that it was very unlikely that the U.S. was going to go into a recession unless we made a major policy mistake. We're staring at two of them right now. Could the Fed get too tight with long rates coming down? And could trade lead to a further strengthening of the dollar and further disruption of supply chains? Neither of those are my base case, because that's akin to shooting ourselves in the foot. We could back off from either of those, but that's what the market's waiting to see.
Tom, we can talk about the dramatic moves. They've been jarring, but just to widen it out a little bit, the S&P is down about 1% year to date, way off its highs, but underneath the index, a ton of damage done, right? You have half of all stocks, as Morgan was just mentioning, down at least 20%. As somebody like you, head of intrinsic value equities, is there intrinsic value being surfaced here?
Things went on sale,
yeah.
Right?
What's been on sale?
Well, semiconductors on sale, energy, the oil services. You mentioned Halliburton, 52-week low. It's trading below where it was when oil was at $28. So you do have sales in different areas. I think there's a lot of fear embedded in the market. And my biggest fear isn't the market pricing. It's the behavior. Company CFOs want some certainty before they make decisions. And right now, that level of uncertainty is very high on trade.
And does that mean you have to, expect earnings estimates to come down more next year, or how does that play out?
Yeah, I think you need to be a little more cautious about earning estimates, but think about it. We've had 20-25% earnings growth this year with a flat market. So now the multiples are much lower, and we still have low interest rates. So when you want to talk about a Goldilocks scenario, moderate multiples, very low interest rates, and even on where we're having pressure, oil prices, that's actually really good for the overall economy. Most people at home, they're not real upset when oil prices go down.
What does have some upset is the fact that no major asset class has gains for the year.
Right.
And you got to go back a ways to see a year like that.
Yeah, you do. I think this is somewhat similar to what we saw in 15 into 16, where the Fed got a little bit too tight and the dollar strengthened. Money came out of the international markets and we got hit across the board in the energy patch and high yield. And that was the last time we had policy uncertainty. 17 was a good year. 18, we got the tax cuts, but that led to tighter financial conditions and trade concerns. So that's where we are. But I don't think that, pretty convinced this doesn't look like the end of the cycle, and investors know we go through market corrections and we'll have to adapt on a policy front. Your question before about everything peak growth, peak margins, peak earnings, just because you're at peak doesn't mean that the cycle ends. Things slowing actually can make this more sustainable and can lead to a continuation of this cycle.
Yeah, I think that's a key point. I just want to note in the next couple of minutes, we're going to have Christine Lagarde on CNBC. Sarah Eisen is going to bring us that interview. So that's going to be must-watch TV. You're not going to want to miss that. Meantime, Tom, you note here in your notes that you're very optimistic. I suspect there's a lot of folks who don't necessarily pay attention to the markets. It's the end of the year. They're opening up their retirement accounts and they're going, what the heck is going on? What would you say to them?
They're flat for the year, and they're flat since Thanksgiving, right? We just talked about that. So volatility is something that actually the biggest danger aren't the people just opening their envelopes today. It's people that are looking at this day to day. And that's where people tend to whipsaw themselves. I would say you need a very long-term focus, but the underlying economy is still strong. We referenced late 2015, early 2016, there was fear of a recession. And there really weren't too many signs other than kind of bond spreads, the corporate bond spread. Well, here it's the same thing. This yield curve inversion has people freaked out. Trade, when you look at trade relative to the overall fiscal stimulus, with the economy still in pretty strong shape.
And so what gets us out of this trap? I mean, in early 2015, it was the Fed.
It's certainty. It's you get some direction from the Fed, you get it from trade, and you saw it on Monday. I was surprised Monday wasn't stronger, given the news from Saturday, but then it gets pulled back right away. I think it's going to be a roller coaster on the trade front.